Sizable beat, David, on inflation, suggesting progress in bringing down price hikes. But there's a question about whether this number will mean more to the markets than it does to the Fed. Here are the numbers we're looking at. 0.1 beating the estimate of 0.3 on the headline number. Year over year, 7.1 versus 7.3, still pretty high. We'll look at that in just a second. And the core up just 0.2, a tenth lower than the estimate. The year over year falling to 6% from 6.1%. Chris Rupke from MUFG writes, inflation is cooling for goods and services this month, and the price increases that wreaked havoc on financial markets will likely cool even further in 2023. For the first time, we can say the Fed is winning its war on inflation. Here are some of the details out there. You had this surge in food prices up 0.5 percentage point. That was offset by a decline in energy prices, a bit more than expected. Used car prices continue to fall, but owner's equivalent rent, a key factor driving inflation, up 0.7%. And services ex energy a bit hotter than either the headline or the core, something that Fed Chair Powell has been watching. Now look at the Fed's fund futures market, now marked down its estimate for the peak funds rate from around 4.99, say before the number. Now it's trading around 4.83. So a sizable chunk of what's expected to be the peak rate in May 2023 lopped off of that number. The big change, though, still baked in for tomorrow, 50 basis points still baked in. But now they're betting on 25 for the February 1 meeting. And some folks are saying, hey, maybe that's it afterwards. All right, now we wait to see if the market's exuberance is embraced by the Fed and Fed Chair Jay Powell. He's pointing to the labor market as a major source of inflation. So he might be happy about this number, but not quite ready to take the victory lap the market seems to want him to take at this point, guys.
Steve, that is where I'm going to pick up, because you just touched on this, but really now, arguably, it's all about the labor market cooling, and until that happens, the Fed is likely to be hawkish. And we've heard that from both current and former officials leading up to the print that we're getting today, and of course this FOMC meeting happening. So walk me through what we saw this morning in terms of wages and how it speaks to the resilience we're seeing in labor.
Yeah, Morgan, first of all, I just want to say personally, I would love to put on the party hat here, and say this is done. It's just my close read of what Powell's been saying suggests that it may be too early for the following reasons. First of all, he has said several times that the Fed is very cognizant and following the history of these things where the Fed raised rates in the 70s in response to higher inflation, then backed off and inflation surged ahead. So I think they're going to want to put a couple buckets on this fire before walking away and deciding that the fire itself is out. And he has pointed, as you say, Morgan, to the jobs market and the tightness in the labor market as an absolute key there for what is driving inflation, and particularly that services ex-housing core inflation number, which is up 2%. So that's a good number. But I think he's still going to be concerned that higher wages from a labor shortage are going to work their way into CPI and into inflation.
You know, the other piece of this, I know we talk about it all the time, Steve, but I mean, just today, right? You got this cooler than expected CPI number, and equities are rallying on it. You got the S&P up 2.25% right now. It speaks to looser financial conditions every time we get a data point that is moving in the Fed's favor towards this tackling inflation narrative. How much does that complicate the picture?
It does complicate the picture, and it could potentially guide Powell in his commentary tomorrow. And for that, you don't have to go back to the 70s for the history. Just go back to the summer where the market became exuberant again, and Powell felt like he needed to kind of, again, pour a bucket of water on that. And then he came out with that a short, sharp, and shock speech in August, Jackson Hole, where he basically said, I'm only thinking about inflation. Inflation is a big problem. I'm not happy yet. And that redirected the conversation more towards where the Fed was wanted it to be. And he's going to be concerned, I think, at some point that interest rates come down more than expected, markets rise more than he wants them to, such that it creates more stimulus to the economy. So we'll see tomorrow if he feels a need to redirect. I think he's going to. Now, look, the Brookings speech last week was a little bit more dovish. The market took it that way, and we'll see if he continues that. But I think he's going to be a little bit more cautious here about what this number means for the outlook for inflation and for Fed policy than the market thinks he's going to be.
It's going to be fascinating, Steve. Thank you. Steve Leisman this morning on CPI and the Fed meeting, which begins today.